A sharp move in silver is drawing attention not because of speculative frenzy, but because of what it reflects underneath the price. Markets are reacting to a growing imbalance between fiscal reality and monetary credibility. As government borrowing accelerates and debt servicing costs rise, investors are reassessing what constitutes a reliable store of value. Silver's surge is occurring alongside persistent deficits, heavy treasury issuance, and limited political appetite for fiscal restraint. This matters now because debt dynamics are no longer abstract projections. They are shaping funding conditions, currency expectations, and asset allocation decisions in real time. When confidence in long-term balance sheets weakens, capital does not wait for policy resolutions. It moves toward assets perceived as scarce, tangible, and outside the direct control of fiscal authorities. The current price action signals that this reassessment is already underway. In the concluding days of 2025, as fiscal authorities worldwide grapple with the ramifications of unprecedented borrowing to sustain post-pandemic recoveries and geopolitical expenditures, the relentless expansion of sovereign debt is systematically undermining investor confidence in the long-term stability of major currencies, prompting a measured but discernible reorientation toward tangible assets like silver. Global public debt has ascended to a staggering $111 trillion this year, an increase of $8.3 trillion from 2024, with the United States and China collectively accounting for 51.8% of this burden, according to comprehensive assessments of fiscal trajectories. This escalation, pushing aggregate global debt to nearly $346 trillion by the third quarter, equivalent to over 235% of world GDP, alters market risk pricing mechanisms well before any overt crisis materializes, shifting focus from cyclical growth indicators to the erosion of purchasing power over extended horizons. In the United States, where gross federal debt has reached 120.9% of GDP as of mid-2025, up from 122.3% in the prior quarter, the Congressional Budget Office projects deficits averaging $1.9 trillion annually, elevating debt to 118% of GDP by 2035 under baseline assumptions. This trajectory, compounded by emerging markets facing record $3.2 trillion in bond and loan maturities through year-end, fosters an environment where investors increasingly anticipate adjustments via inflationary channels or financial repression rather than disciplined fiscal consolidation. Silver, trading at approximately $79 per troy ounce as of December 28, benefits profoundly from this milieu, as its intrinsic value operates independently of governmental liabilities, attracting capital flows seeking insulation from the promise-based vulnerabilities inherent in fiat systems. The mechanics of this erosion are rooted in the disproportionate growth of obligations relative to economic output, compelling markets to embed premiums for long-term currency dilution that manifest in subdued real returns on conventional assets. Low- and middle-income countries have endured net external debt outflows totaling $741 billion from 2022 to 2024, the largest in 5 decades, straining fiscal resources and amplifying concerns over currency stability as debt servicing diverts funds from productive investments. In advanced economies, the Organization for Economic Cooperation and Development forecasts sovereign bond issuance reaching a record $17 trillion in 2025, up from $14 trillion in 2023, with persistent deficits inflating servicing costs that consume escalating portions of budgetary allocations. This fiscal crowding out effect heightens the probability of policy responses favoring inflation tolerance or regulatory measures to cap yields, such as yield curve control, which erode the real value of cash and bonds over time. Investors, attuned to these risks, are recalibrating portfolios not in panic but through systematic hedging, evidenced by silver's 170% year-to-date surge, outpacing gold's advance and reflecting its dual role as an industrial staple and monetary hedge detached from sovereign creditworthiness. Unlike Treasury securities, which depend on the issuer's commitment to fiscal discipline amid deficits totaling $1.7 trillion over the past 12 months and debt approaching 100% of GDP, silver's scarcity and physicality ensure value retention irrespective of policy pivots, drawing inflows from institutions reassessing exposure to high-debt regimes. This gradual weakening of confidence unfolds through investor behavior that prioritizes tail risk mitigation over yield chasing, as rising debt burdens signal structural compressions in real returns across financial assets. The Institute of International Finance's monitoring indicates global debt climbing to $338 trillion, with emerging markets confronting heightened redemption pressures that exacerbate currency volatility and prompt de-dollarization efforts. In such contexts, the likelihood of future adjustments via currency dilution, through expanded monetary bases or tolerated inflation escalates, as governments facing debt-to-GDP ratios exceeding 100%, like the United States at 124.3%, opt for paths of least resistance over austerity. Silver's appeal intensifies here, as central banks and sovereign funds, having acquired over 600 tons of gold this year, begin incorporating silver into reserve strategies, with at least 3 major institutions, Russia, India, and Saudi Arabia, purchasing over $1 billion worth in 2025 to diversify against fiat vulnerabilities. This demand, not driven by speculative frenzy but by prudent risk management, anchors silver prices at elevated levels, with forecasts eyeing $75 to $88 per ounce by late 2025, reflecting its insulation from the policy dependencies that afflict bonds and cash holdings. As debt servicing in OECD nations claims a larger fiscal share, projected to rise amid record issuance, investors embed premiums for erosion in purchasing power, fostering portfolio shifts that favor assets like silver, whose value derives from scarcity rather than governmental promises. The interplay between burgeoning deficits and currency perceptions further accentuates this erosion, as markets anticipate inflationary accommodations to manage unsustainable trajectories, thereby compressing real yields on fiat-linked instruments. Europe's 21% share of the $111 trillion in global government debt underscores regional strains, with the United Kingdom contributing significantly to this aggregate amid its own fiscal challenges. Such environments heighten scrutiny on long-term stability, where persistent deficits, averaging 6% of GDP in advanced economies, increase the propensity for financial repression, such as regulatory caps on interest rates or mandatory domestic holdings, which dilute currency value over time. Silver, positioned outside this liability framework, accrues strategic value. Its rally to past $75 per ounce in December, propelled by industrial tightness and safe haven bids, illustrates how investors hedge against scenarios where real returns on bonds are structurally suppressed, with yields failing to outpace inflation in high-debt regimes. Institutional behavior in 2025, including sovereign funds warming to hard currency emerging market debt while diversifying into metals, reflects this reassessment, as elevated debt levels prompt a focus on assets resilient to policy-induced dilution. This incremental weakening fosters a feedback loop, where diminished confidence in fiat stability accelerates demand for alternatives, sustaining silver's upward bias even as broader markets navigate uncertainty. As sovereign obligations outpace GDP growth, global public debt surpassing $100 trillion in 2024 and continuing its ascent, markets internalize heightened risks of currency debasement, recalibrating expectations for future policy paths that favor erosion over restraint. The World Bank's International Debt Report for 2025 highlights how low- and middle-income nations face record outflows, doubling the number of countries with net debt burdens over the decade, amplifying global currency volatility as fiscal resources strain under servicing demands. In this context, silver's detachment from such cycles positions it as a beneficiary, with central banks exploring its inclusion in reserves alongside gold, as evidenced by purchases from key players amid geopolitical strains that elevate tail risks for fiat assets. Investor portfolios, confronting the consequences of rising debt, such as spiked interest costs since 2020 and potential tax hikes to sustain dominance, shift toward hedges that preserve purchasing power, driving silver's integration into systematic strategies where real returns are prioritized over nominal yields in compressed environments. This behavioral adaptation, gradual yet persistent, underscores the alarming undercurrents of debt expansion, where confidence in currency stability frays at the edges, fostering sustained demand for silver as a counterweight to the vulnerabilities of promise-based systems. The fiscal dominance implied by these trends further erodes trust, as governments increasingly rely on monetary accommodation to manage burdens, heightening prospects for dilution that investors preempt through diversified allocations. With U.S. debt projected to rise under 2025 policy measures offsetting deficits via tariffs but inflating primary shortfalls, the interlinkage between sovereign debt, currency, and banking stability becomes pronounced, as panel analyses reveal heightened probabilities of crises in overleveraged regimes. Silver's role amplifies here, detached from these three sisters of risk, attracting capital as a non-issuer asset that retains value. It's such interconnections, with its price trajectory jumping past $75 amid central bank interest, reflecting this hedge demand. As debt consumes fiscal space, confidence weakens incrementally, prompting portfolio behaviors that embed premiums for erosion, sustaining silver's appeal in a landscape where real asset hedges mitigate the structural compressions facing financial instruments. This ongoing process, where expanding debt recalibrates risk perceptions, positions silver as a strategic beneficiary, its value proposition rooted in independence from policy contingencies that increasingly threaten fiat stability. With global debt dynamics fostering environments of elevated macroeconomic uncertainty, investors' shift toward tangible hedges like silver represents a prudent response to the gradual but profound implications of fiscal overextension. In the final days of 2025, as central banks worldwide conclude a year marked by calibrated policy adjustments amid elevated inflationary pressures and geopolitical uncertainties, the constraints imposed by soaring sovereign debt levels are profoundly amplifying the allure of hard assets like silver, which offer valuation stability independent of interest rate cycles. Global public debt has surged to approximately $111 trillion, an increase of $8.3 trillion from the previous year, with the United States and China accounting for over half of this aggregate, underscoring a structural imbalance where obligations now exceed 100% of global gross domestic product in many advanced economies. This escalation limits the maneuverability of monetary authorities, as aggressive tightening elevates government borrowing costs, potentially adding trillions in interest expenses over the decade, while prolonged easing erodes currency credibility by fueling perceptions of fiscal dominance. The Federal Reserve, having maintained its benchmark rate at 4.25 to 4.5% in December, navigates this narrow corridor with heightened caution, where further hikes could exacerbate the U.S. federal debt servicing burden, now consuming a larger share of budgetary resources amid gross debt reaching $38.4 trillion. In Europe, the European Central Bank's efforts to balance disinflation with debt sustainability face similar binds, as sovereign bond issuance across OECD nations is projected to hit a record $17 trillion this year, up from $14 trillion in 2023, constraining the scope for rate normalization without triggering fiscal stress. This policy constriction breeds uncertainty regarding the management of future shocks, such as supply chain disruptions or energy price spikes, prompting markets to gravitate toward assets whose intrinsic worth does not hinge on central bank interventions. Silver, currently trading at around $79 per troy ounce following a 170% year-to-date advance, exemplifies this heightened appeal, benefiting from its hybrid status as both a monetary hedge and an essential industrial input integral to sectors like photovoltaics and electronics. Unlike conventional financial instruments, whose valuations are tethered to yield curves manipulated by policy rates, silver's demand profile remains anchored in real economic activity, with global industrial fabrication projected to absorb nearly 700 million ounces in 2025, driven by China's dominance in solar panel production exceeding 500 gigawatts annually. This duality insulates it from the policy trade-offs increasingly visible in high-debt regimes, where central banks must weigh the risks of overheating against fiscal sustainability. For instance, the Bank for International Settlements has highlighted how elevated debt levels, surpassing 235% of global GDP, curtail the efficacy of traditional tools, as tightening exacerbates interest costs that could rise by 20–30% in advanced economies over the next 5 years, while easing invites currency debasement perceptions amid sticky inflation above 2% targets. Investors, responding to this narrowed flexibility, are diversifying into silver not through speculative leverage, but via structural allocations that mitigate exposure to policy reversals, as evidenced by central bank explorations of silver purchases, with Russia, India, and Saudi Arabia acquiring over $1 billion worth this year to complement gold holdings. The constraints on monetary policy are particularly acute in the United States, where federal debt has ballooned to $38.4 trillion, increasing by $2.23 trillion year over year, equivalent to over $6.12 billion per day, forcing the Treasury to issue record volumes of securities amid deficits projected at $1.8 trillion for fiscal 2025. This fiscal overhang limits the Federal Reserve's capacity for sustained tightening, as higher rates would amplify interest payments, already approaching $1 trillion annually, potentially crowding out discretionary spending and heightening recession risks. Concurrently, prolonged accommodation risks undermining the dollar's credibility, as persistent deficits fuel concerns over long-term purchasing power erosion, a dynamic that has propelled silver's rally as markets seek assets resilient to such uncertainties. Emerging markets, facing $3.2 trillion in bond and loan maturities through year-end, confront analogous dilemmas, where high debt levels, averaging 93% of GDP in low-income countries, constrain central banks from aggressive interventions without exacerbating currency depreciation or capital outflows. Silver's industrial linkage provides a stabilizing counterweight, with demand from electric vehicles and renewable infrastructure projected to grow at 3.4% compounded annually, ensuring sustained offtake that buffers against policy-induced volatility in financial markets. As these trade-offs become more pronounced, confidence in traditional monetary tools wanes, fostering an environment where uncertainty about shock absorption, such as potential escalations in U.S.-China trade tensions or European fiscal divergences, drives portfolio diversification toward hard assets. The Organization for Economic Cooperation and Development's Global Debt Report for 2025 warns that sovereign issuance at $17 trillion elevates refinancing risks, limiting central banks' leeway and increasing the propensity for financial repression measures like yield caps, which compress real returns on bonds and cash. In this context, silver's appeal intensifies as its valuation derives from scarcity and utility rather than policy support, attracting inflows from sovereign entities exploring its inclusion in reserves amid gold purchases totaling 634 tons this year, with October alone seeing 53 tons added globally. Investors respond by building positions that hedge against scenarios where central banks, constrained by debt dynamics, opt for easing that dilutes currency value, as seen in projections for U.S. interest costs surpassing $1 trillion annually, eroding fiscal space and heightening sensitivity to external shocks. This structural demand for silver, manifesting in exchange-traded fund inflows and physical acquisitions, sustains price elevations without reliance on momentum trading, reflecting a broader reassessment of asset classes in a policy-constrained world. The Global Debt Monitor from the Institute of International Finance, reporting totals nearing $346 trillion by the third quarter, highlights how this overhang, rising by $26 trillion in the first 9 months, amplifies monetary policy dilemmas, where tightening exacerbates rollover risks for emerging markets facing $741 billion in net outflows from 2022 to 2024. Central banks in these regions, including those in BRICS nations, are turning to silver as a complementary hedge, with reports of acquisitions exceeding $1 billion by key players, bolstering reserves against the backdrop of dollar dominance erosion and policy limitations imposed by high leverage. This diversification mitigates vulnerabilities to rate reversals, as prolonged easing in high-debt contexts risks credibility losses, prompting inflationary expectations that further compress bond yields in real terms. Silver's industrial demand, projected to absorb 200 million ounces in photovoltaics alone, provides a real economy anchor, ensuring its valuation withstands such uncertainties, unlike fiat assets tethered to policy credibility. As debt servicing claims escalating fiscal resources, interest payments in the U.S. alone rivaling defense spending, monetary authorities face intensified trade-offs, where flexibility diminishes and uncertainty proliferates regarding future crisis responses. The World Bank's International Debt Report for 2025 emphasizes how low- and middle-income countries, doubling in number with net outflows over the decade, confront heightened constraints, limiting aggressive tightening without triggering defaults or easing without devaluation pressures. In advanced economies, the Deloitte analysis of U.S. national debt casts a fiscal shadow, noting how surging obligations influence investor sentiment and monetary policy, elevating the appeal of assets like silver that derive value from intrinsic properties rather than policy support. This environment fosters sustained demand for silver, as central banks ramp up explorations, with silver jumping past $75 amid central bank interest and industrial tightness, reflecting a structural shift where policy constraints drive diversification. Investors managing trillions in assets respond by allocating to hard assets less sensitive to reversals, ensuring silver's position strengthens amid visible trade-offs. The result is a persistent elevation in silver demand, grounded in structural monetary constraints rather than fleeting momentum, as high debt levels, public debt at $99.2 trillion globally, curtail central bank options and weaken fiat confidence incrementally. UNCTAD's World of Debt 2025 report notes global public debt surpassing $100 trillion in 2024, with countries facing net outflows doubling, amplifying policy dilemmas where easing risks credibility while tightening burdens servicing. Silver, with its dual attributes, captures this hedging flow, sustaining prices at records as markets prepare for an era of constrained tools and distributed financial power. This unfolding constraint on monetary flexibility, amid debt ratios like the U.S. at 120.9% of GDP, heralds a regime where hard assets like silver gain prominence, their appeal amplified by the narrow corridor that limits effective shock management. As investors diversify, demand persists, reshaping portfolios in response to the alarming fiscal-monetary interplay defining 2025's close. In the final days of 2025, as global financial markets approach year-end settlements amid heightened volatility in sovereign bond yields and commodity futures, the surge in silver prices to approximately $79 per troy ounce stands as a stark indicator of underlying systemic stress permeating the international economic order, far beyond the confines of isolated speculative enthusiasm. This ascent, marking a staggering 170% year-to-date gain and eclipsing gold's performance, is not a transient phenomenon driven by fleeting headlines or retail fervor, but a manifestation of deeper structural imbalances where escalating government borrowing and refinancing imperatives are compelling investors to reevaluate the viability of long-duration financial assets. The silver market, with its relatively modest capitalization compared to equities or fixed income, total above-ground stocks estimated at under $1.5 trillion, amplifies these shifts, where even marginal reallocations from institutional portfolios trigger rapid price adjustments, reflecting a broader recalibration of risk premia in a system burdened by unprecedented leverage. Global public debt has surpassed $100 trillion in 2024, with projections for 2025 indicating continued acceleration as nations contend with maturing obligations and persistent deficits, creating a liquidity environment where capital increasingly seeks refuge in tangible assets insulated from fiscal vulnerabilities. This context underscores that silver's rally is emblematic of markets preemptively pricing in long-term strains, anticipating resolutions through mechanisms like inflation tolerance or financial repression rather than outright defaults. The confluence of elevated government borrowing and growing refinancing needs forms the bedrock of this systemic tension, where sovereign issuance across maturities is straining global liquidity pools and prompting a reassessment of exposure to debt-dependent instruments. In the Organization for Economic Cooperation and Development countries alone, sovereign bond issuance is projected to reach a record $17 trillion in 2025, up from $14 trillion in 2023, as governments roll over existing liabilities amid rising interest costs that consume escalating portions of fiscal resources. The United States exemplifies this pressure, with the Treasury Department facing the need to refinance nearly one-third of its $36 trillion national debt by year-end, including over $9.2 trillion in maturing obligations that must be rolled over in an environment of softening foreign demand for treasuries. This refinancing imperative, coupled with net issuance exceeding $2 trillion annually, heightens liquidity demands at a time when central banks are navigating narrow policy corridors constrained by inflationary risks and geopolitical frictions. Emerging markets compound this global picture, confronting a record $3.2 trillion in bond and loan redemptions through the remainder of 2025, with low- and middle-income countries experiencing net external debt outflows of $741 billion from 2022 to 2024, the largest in 5 decades, further tightening international capital flows. In this milieu, silver's market dynamics, characterized by a structural supply deficit of 215 million ounces against industrial demand projected at 680.5 million ounces, serve as a barometer, where price discovery accelerates as capital migrates from long-duration bonds susceptible to yield spikes toward assets with intrinsic scarcity and industrial utility. The metal's relatively small market size, with annual mine production stagnating at around 820 million ounces, ensures that reallocations from even a fraction of the $120 trillion in global reserves have outsized effects, pushing spot prices to new highs without the need for widespread panic selling in traditional assets. This recalibration is not a response to isolated inflationary data points or ephemeral news cycles, but a reflection of markets internalizing the broader implications of a heavily leveraged system where fiscal trade Tories erode confidence in long-term asset preservation. The International Monetary Fund's Global Financial Stability Report for October 2025 flags elevated risks from stretched asset valuations and sovereign bond pressures, noting that financial stability vulnerabilities persist amid growing debt service burdens that could amplify shocks in a fragmented global economy. Concurrently, the Bank for International Settlements assessments highlight looming systemic risks from private credit expansions and high leverage, where concerns over ratings integrity and liquidity mismatches could cascade into broader market dislocations. Silver's rise, occurring alongside these warnings, signals that investors are preemptively adjusting to scenarios where refinancing needs, such as the U.S. facing 20% of outstanding debt maturing in fiscal 2025, constrain policy responses, potentially leading to higher baseline yields and compressed real returns on financial instruments. The Federal Reserve's November 2025 Financial Stability Report reinforces this, identifying risks from non-bank intermediaries and asset overvaluations that could exacerbate liquidity strains in a high-debt context. In emerging markets, the World Bank's International Debt Report for 2025 details how external debt for International Development Association-eligible countries rose to $1.2 trillion, with net outflows doubling the number of affected nations over the decade, further fragmenting global capital allocation, and pushing capital toward tangible hedges like silver, whose dual monetary and industrial roles provide resilience against such systemic imbalances. The small scale of the silver market relative to the vastness of global debt, where total liabilities approach $338 trillion, including $251 trillion in nominal terms, ensures that even modest shifts in investor allocation yield rapid price effects, as capital seeks protection from the imbalances inherent in over-leveraged sovereign balance sheets. Institutional behavior in 2025, including sovereign funds and central banks warming to silver as a complementary asset to gold, reflects this migration, with acquisitions exceeding $1 billion by key players amid a broader de-dollarization push that diverts surpluses from Treasury purchases. This is particularly evident in BRICS economies, where collective efforts to reduce reliance on U.S. debt instruments, amid U.S. Treasury issuance surging to accommodate deficits, channel capital into precious metals, amplifying silver's price sensitivity due to its limited supply elasticity, with mine output declining for the past decade and recycling volumes insufficient to offset industrial demand growth. The metal's industrial consumption, projected to hit record highs driven by photovoltaic applications absorbing nearly 200 million ounces, provides a real economy foundation that buffers against speculative reversals, ensuring that price discovery remains upwardly biased as systemic leverage concerns mount. Analyses from veteran investors targeting silver at $300 in a potential mania phase highlight this structural repricing, where the asset's scarcity intersects with fiscal strains to produce sustained elevations, not contingent on short-term catalysts, but on the pervasive recalibration of risk in a debt-saturated system. As government borrowing intensifies, with U.S. federal debt climbing by $2.23 trillion year-over-year to $38.4 trillion, equivalent to over $6 billion daily, markets are embedding premiums for long-term strain into current valuations, anticipating resolutions that favor dilution over discipline and thereby elevating tangible assets like silver as protective mechanisms. This process is amplified by the global refinancing wave, where emerging markets face $3.2 trillion in maturities, straining liquidity and prompting secondary effects on developed market yields as capital flows fragment. Silver's market, with its concentrated supply chain and dependence on byproduct mining from base metals, responds with heightened volatility to these pressures, where allocation shifts from even a small subset of the $120 trillion in sovereign reserves can propel prices through rapid discovery phases, as observed in its outperformance against oil and other commodities this year. The Boston Federal Reserve's 2025 update on banking system vulnerability, noting risks from high leverage and asset mismatches, further contextualizes this, where systemic concerns extend beyond banks to sovereign balance sheets, driving demand for assets uncorrelated with fiscal trajectories. In this framework, silver's rise signals markets' forward-looking integration of these imbalances, where the asset's industrial indispensability, consuming over half of annual supply, intersects with monetary hedging to sustain valuations amid weakening fiscal confidence. The broader recalibration of risk occurring against a backdrop of increased issuance across maturities, U.S. Treasury auctions absorbing record volumes to finance deficits, underscores that silver's elevation is a harbinger of systemic adaptation, where investors preempt crisis events by pricing in the probabilities of protracted strain. The Financial Stability Oversight Council's 2025 annual report emphasizes ongoing monitoring through its Systemic Risk Committee, highlighting vulnerabilities from high debt and market interconnections that could amplify shocks without immediate triggers. This vigilance aligns with silver's role as a barometer, where its small market size facilitates outsized responses to capital-seeking protection, as seen in forecasts anticipating continued highs into 2026 driven by supply deficits and investor reallocation. As refinancing needs mount, over 20% of U.S. debt maturing in fiscal 2025, liquidity pressures intensify, diverting flows from long-duration assets vulnerable to yield spikes towards silver, whose price discovery mechanism adjusts swiftly to incorporate these systemic signals, ensuring that today's valuations embed tomorrow's fiscal realities without awaiting confirmatory disruptions. When confidence in fiscal trajectories falters, as evidenced by the doubling of countries experiencing net debt outflows over the decade and global debt climbing to $338 trillion, tangible assets like silver gain renewed relevance, serving as conduits for capital preservation in a leveraged system prone to amplification effects. This is particularly salient in a year where silver has surpassed oil in value for the first time historically, driven by macroeconomic tailwinds and a re-rating of tangible assets amid fiscal overextension, where industrial demand intersects with safe haven bids to sustain momentum. The metal's rise, therefore, encapsulates a profound market judgment. Systemic stress from borrowing and issuance is not a distant threat but a present reality being discounted into asset prices, compelling a shift that prioritizes resilience over yield in an era of pervasive leverage.